Hey everyone, welcome back to Corporate Decoder. Today, E.Q.P.E just filed their latest quarterly report at 10Q, and I'm seeing some interesting growth and some key shifts in their investments that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is growing fast, and their latest report shows a big jump in just about everything, especially their investments. We'll break down where their money is going and what it means for their future. Alright, let's dive into the core numbers. Looking at their balance sheet as of the 31st of March 2026, we see total assets have climbed to over $817 million. That is a significant jump from around $636 million at the end of 2025. The biggest piece of this growth is their investments. Investments at fair value are now at almost $739 million. Up from about $602 million just a few months prior. That is a massive increase, showing they are actively putting money to work. Their cash position also looks healthy, sitting at about $66 million. This gives them plenty of flexibility for future deals. On the flip side, liabilities are around $24 million, which is actually down a bit from the previous period. This means they are managing their debts well as they grow. The resulting net assets are over $793 million, a big leap from about $610 million late last year. This jump in net asset value really highlights the company's expansion. Now let's talk about their shares. The number of outstanding shares has increased substantially from about 21.5 million at the end of 2025 to over 28 million by March 2026. This is driven by new share issuances as they raise more capital. The Class A shares, for example, saw a significant increase in outstanding shares, going from about 7.5 million to over 10.9 million. This means more investors are coming on board, or existing investors are putting in more money. Let's switch gears to their operations. For the first 3 months of 2026, they reported total investment income of about $641,000. While this is a positive number, it is important to note that most of their gains are coming from investments, not necessarily from current operations. Expenses are a key area to watch. Their net operating expenses after reimbursements from the manager came in at almost $1.85 million for the quarter. This shows they are incurring costs to manage their growing investment portfolio. The net change in unrealized appreciation on investments and foreign currency translation was a positive $1.74 million for the quarter. This means the value of their investments has gone up on paper, contributing to their overall asset growth. When we look at their net increase in net assets from operations, it was about $150,000 for the first quarter of 2026. This is a relatively small number compared to their investment gains, reinforcing the idea that their growth is largely driven by the appreciation of their investments. Now for the most exciting part, where is their money actually invested? Their schedule of investments as of the 31st of March 2026 shows a massive portfolio valued at over $805 million. The vast majority of this, about $739 million, is in portfolio companies. These are the core businesses they are investing in. We see major holdings in information technology, which makes up over 61% of their portfolio. Within it, NeoGov is a big one, valued at nearly $100 million. Fortnox is another significant investment, worth over $84 million. IFS and Aveda also represent substantial chunks of their IT portfolio. They also hold significant investments in healthcare, around 12.4% of their portfolio, and other sectors like consumer discretionary and industrial. It's interesting to see that almost all of their portfolio companies are valued at level 3 in the fair value hierarchy. This means their values are based on unobservable inputs, making them estimates. This is typical for private equity investments where there isn't a ready market price. The weights ascribed to market comparables and transaction prices are key here, with market comparables being a heavier influence at 77%. Wait, no, this is not Nordic Capital. This is EQT Private Equity Company, LLC. Let's realign. Their portfolio company, Nord Anglia, is a big player in the consumer discretionary sector, valued at over $46 million. This company is an international schools organization, and it represents a significant part of their consumer-focused investments. Besides their direct portfolio companies, they also hold about $66 million in money market funds. These are generally safe, liquid investments like the Morgan Stanley Liquidity Government Institutional Fund and the JP Morgan US Government Capital Fund. This cash is essentially on standby, ready to be deployed or to cover operational needs. When we look at the valuation of these level 3 investments, the method relies heavily on inputs like enterprise value to EBITDA multiples, which are in the range of 11.9x to 18.9x. They also use enterprise value to revenue multiples around 8.2x and price to book multiples at 2.4x. The sensitivity to these inputs is high. For instance, the impact of valuation from an increase in the enterprise value to EBITDA multiple would be an increase as expected. A 10% hypothetical drop in the value of these level third holdings could mean a hit of nearly $74 million to their net assets. This is a crucial reminder that these private equity valuations are estimates and subject to change. Let's compare this to the end of 2025. Their total investments were around $625 million back then, with portfolio companies making up the bulk of that at $602 million. This shows a significant increase in their investment portfolio over just a few months. The allocation to money market funds was much smaller then, at about $22 million. This indicates a clear strategy to deploy more capital into their core businesses. Now, let's touch on expenses and related parties. The company has incurred organization and offering costs which are normal when setting up and growing a business. For the first quarter of 2026, offering costs were about $585,000. These costs are being amortized over the first 12 months of operations. There is also an expense limitation and reimbursement agreement with their manager, EQT Partners Inc. This agreement essentially caps the company's specified expenses at 0.75% of net assets. The manager has agreed to shoulder certain costs with the potential to recoup them later, as of the 31st of March 2026. They have about $1.6 million in expenses subject to recoupment by the manager, with a 5-year window to do so. This is a pretty standard arrangement in private equity to ensure the manager's interests are aligned with investors and to control costs. The management fee is calculated based on the company's net asset value at rates between 1.00% and 1.25% per annum. For the first quarter of 2026, this fee amounted to about $348,000. This is a direct cost of having the manager oversee their investments. The performance allocation is where the manager gets a cut of the profits, set at 15% of the total return above certain hurdles and with a high water mark. For the first quarter of 2026, no performance allocation was recognized. This isn't surprising as these allocations are often measured annually. However, they did have a significant accrued performance allocation of over $7 million at the end of 2025, which was paid out in the first quarter of 2026. This shows that when the company performs well, the manager does get rewarded. Looking at subsequent events, a key development is their continuous private offering. As of the 1st of April 2026, they sold investor shares for about $61.4 million. Then, on May 1, 2026, they raised another roughly $28.8 million. This shows consistent capital inflow fueling their investment strategy. Interestingly, on May 8, 2026, they did make a small share repurchase of 2,000 shares of Class AJ1 for about $55,000. This suggests they are starting to buy back shares, though it is a very minor amount right now compared to their overall size. In their management discussion, they highlight their strategy to acquire, own, and control joint ventures and portfolio companies globally. They're focused on controlled stakes in businesses and aim for long-term capital appreciation, leveraging EQT's expertise. They are also building out a liquidity portfolio of about 20% of assets consisting of cash, money market funds, and other liquid investments. This is a smart move to maintain some flexibility and ability to meet obligations like share repurchases. They also touch on the current macroeconomic environment, noting uncertainties from inflation, high interest rates, and geopolitical instability. This is a standard but important disclosure, acknowledging the external factors that could impact their investments. The report shows they raised about $187 million in the first quarter of 2026 and used a significant portion of that, around $128 million, to acquire new portfolio companies. This active deployment of capital is a strong indicator of their growth trajectory. Their transactional net asset value, which is the price at which they buy and sell shares, is reported to be over $809 million as of the 31st of March 2026. This is higher than their GAAP net asset value, mainly due to adjustments for accrued shareholder servicing fees. The discussion on valuation methodologies is crucial. They rely on market comparables and transaction price analysis. For metrics like enterprise value to EBITDA multiples, they are seeing ranges from 11.9x to 18.9x with a weighted average of 17.4x. This highlights that their valuations are based on industry benchmarks and recent transactions. The valuation of their portfolio companies is called out as a critical accounting estimate. This is because these valuations are estimates of fair value and may not perfectly align with the actual amount they could realize if they were to sell those investments. Given that these are private equity stakes, this is a common and important point to understand. Their liquidity position seems strong, with over $66 million in cash and cash equivalents. They expect this to be sufficient to cover their needs for the next 12 months, primarily for acquiring more companies, managing operations, and potential share repurchases. Regarding market risks, they highlight fair value risk, exchange rate risk, and interest rate risk. For fair value risk, they estimate a 10% hypothetical drop in their level third portfolio companies could impact net assets by over $73 million. They also have some exchange rate exposure, with an estimated 10% unfavorable move potentially costing them around $2,000. Currently, they have no indebtedness, so interest rate risk from borrowings is not a factor. Finally, they disclose that their internal controls and procedures are effective, meaning they are reporting information accurately and on time. Overall, EQT Private Equity Company LLC is demonstrating strong growth in its investment portfolio. The company is actively deploying capital into new companies, particularly in the information technology sector. While the valuations of these private assets are estimates, the company's healthy liquidity and clear strategy for growth are positives. The key risk to watch will be the performance and ultimate realization value of these private equity investments, especially given the current economic uncertainties. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.